How is the crack spread used by oil refiners? Imagine turning raw crude oil into gasoline and diesel, then figuring out if that process makes money or not. That's what the crack spread helps refiners do. It's a simple way to see how profitable refining can be at any moment. The crack spread measures the difference between what it costs to buy crude oil and what the refined products sell for in the market. This difference is called the gross margin, and it shows if refining is likely to be profitable before subtracting operational costs. Refiners mainly look at the crack spread because it shows how much they could potentially earn from each barrel of crude they process. The most common ratio used is the 3-to-2-to-1 spread. That means 3 barrels of crude oil are expected to produce 2 barrels of gasoline and 1 barrel of diesel or heating oil. This ratio simplifies the complex process of refining into a clear picture of revenue from the main products that generate most of the money. Refiners use the crack spread in several ways. First, they look at it as an indicator of profitability. When the crack spread is high, it suggests they can make good money from refining. When it drops or turns negative, margins shrink or turn into losses. Second, they use the spread to manage risk. By buying and selling futures contracts on crude oil and refined products, they lock in prices and protect themselves from sudden market swings. This is called hedging. Third, the crack spread helps refine their operations. It guides decisions on which crude oils to process and how to adjust the mix of products they produce. Since different crude oils yield different amounts of gasoline and diesel, and demand varies by season and region, the crack spread helps optimize these choices. Finally, tracking the crack spread over time allows refiners and investors to analyze market trends. They can see when refining margins are improving or shrinking, which influences decisions like upgrading facilities or shifting focus to certain products. For investors interested in commodities, understanding the crack spread is key. It reveals the health of the refining sector and potential profit opportunities. Traders often use crack spread data to develop strategies, such as spread trades, where they bet on the change in the price relationship between crude oil and refined products. This makes the crack spread a vital link between crude oil markets and refined product markets, giving a clear picture of refining economics and investment chances. In short, the crack spread is a practical tool for oil refiners to measure margins, manage risks, plan operations, and interpret market signals. For those investing in commodities, it's a helpful indicator of refining profitability and a way to structure trades based on shifts in the price differences between crude oil and refined fuels.